this is Manesh Patel from Ichimoku Trade. Today I want to talk to you about options and talking about the reward versus risk. In order to succeed, we always talk about, and we've been doing this for years, we talked about money management is very critical. In fact, it overrides fundamentals and also overrides technical analysis. In order for you to consistently make money, you have to sit there and find trades that give you a 3-to-1 reward risk ratio. Okay? Now, if you don't understand what 3-to-1 reward risk ratio, then what it means is that if you look at the risk, you have to sit there at least make 300% more based on what you're risking. Okay? Now, a lot of companies out there are sitting there marketing to you. They're talking about a 10% gain, a 15% gain, a 8% gain, and stuff like that. That sounds great, and the reason why it sounds great is that if you look at how much you make in a savings account or CDs or anything like that, that's very minute. And when you sit there and learn about something that's making 10% return and stuff like that, you're getting very, very excited. But remember, those returns are based on the risk that you're putting into that trade. Okay? And if you're sitting there taking a trade where you're making less than 300% return off your risk, it is an inverted reward risk ratio. Sooner or later, you'll sit there and lose all your money. You'll keep on winning, you'll win, and then what can happen is in one day, 1 week, or 1 month can wipe out years or months of profit. You don't want that to happen at all. Money management is very key. You have to be able to make 300% return based off your risk or more. Okay, I'm going to show you a trade here of a 655% so far profitable trade on a particular option trades that we're taking. This is a trade that we take, something that we teach in our options university, how to do what we call pre-earnings strategies. Right before earnings, make a decision on a particular stock and go with the flow as long as the Greeks basically are on your side. Now, if those words don't make sense to you, don't worry. We're going to walk through some of those things. Before we begin, let's go through and go for our disclaimer here. This is for education use only. We're not soliciting you to buy or sell any particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group. You cannot copy or distribute this information without our written permission. We are broker neutral, but for today what we're going to do is we're going to use Thinkorswim from TD Ameritrade to show you the option charts, the option chain, the risk graph, and also the charts dealing with the particular trade. If you have any questions, you could give us a call here at any of these office locations, or you could email us at this office location here. Okay, so let's go down and look at a chart. What we did was we have a pre-earning strategy that we teach in our options university, and McDonald's was a perfect example here, roughly around October 20th. Okay. And what happened here on October 20th, we have to make a decision right before earnings if this is going to be bullish or bearish. If it's bullish, what we're going to do is we're going to look at calls on betting in the instrument going up. If we're bearish, we're going to look at the instrument going down by buying basically puts. Now, in order to determine the strategy whether to buy a single call, single put, we have to analyze the Greeks. If we notice that the volatility is at its average or low, we're basically going to buy a call or put. If the volatility is high, then what's going to happen is that we're basically going to sit there and go to a vertical spread strategy, because IV is high. That means there's a lot more premium built into it, so we have to go to a vertical strategy. Okay, in this case for McDonald's, when we looked at this option strategy before earnings, normally the option chains have a high volatility. In this case, basically the market makers had a high IV on the put side, but not on the call side. So we actually ended up buying a call for McDonald's right before earnings announcement came. Okay, the reason why is volatility was its average or low, and that's why we bought a call. The other thing is we have to determine the strike price. Now for McDonald's, if you looked at it here on earnings and everything, if you looked at it on all the higher time frames, basically McDonald's was consolidating on a weekly time frame all the way up here. And if you looked at it a day before earnings, we're right here at the resistance level here. So if it broke here, this would possibly start a trend on the weekly time frame. Since we're dealing with a weekly time frame, those trends could last anywhere to around 6 months to 8 months. So we wanted to make sure that we were looking at this trade here roughly around here in October. We wanted to make sure we bought ourselves enough time. Okay, so what we did was we looked at January options here, and basically we looked at January options and we went out of the money when we looked at this trade. As you noticed, the stock was around $104 a share. Okay, so now let me go to the option risk graph. Here's the risk graph here. Your P&L is on the y-axis. The stock price is here on the x-axis. We're going to ignore the white line. The purple line is basically our P&L at expiration depending on where the stock is. Here's the one contract here. We bought January 16th, 115 calls. Okay, notice the stock was at 104. We basically bought 115 calls. This is another example where we're defying this notion that basically buying 3 or 4 strikes out, way out of the money on and a couple of months out does not work, because you're sitting there taking trades that are not within the probability expiring at all. So we're showing you another example where you can buy things very, very cheap, and basically as long as you have time on your side, which we did, and as also if you're looking at charts, which we did. Okay, if you look at the trade here, this here you can see we bought October 20th, 11:30 a.m. Eastern Standard Time. They were going to announce earnings after market on the 20th, which basically the results would be seen on market open on the 21st of October. We basically bought 115 calls. We bought them for 50 cents there, and you could see today they're worth $3.77. Okay, so basically we took $50 and we turned it into $377. So we could sell this right now for $377. And if you think about it, that's over a 655% gain. And here's the best part. We still have some time. We still have over 30 days still left for this option to expire. And if McDonald's keeps on going up, for every dollar move that goes up, we're going to make another $56 in profit. So this potentially, if the markets go up and if technical analysis shows up, we possibly before January expiration, we could sit there and close this trade out for 1,000% gain. Things that people can't even fathom because you guys are trying to achieve 10%, 15% and stuff like that. We're not doing that. We're sitting there having a 3-to-1 reward risk ratio, and we're sitting there trading everything off charts. That's one of the reasons why we could sit there, go 3 or 4 strikes out of the money, and go out a couple of months out, keep our options costs down to 50 cents or around that level, and then we could sit there and make 3-to-1 reward risk ratio or more. Okay, this is a live student account. This is an account that basically I use for Options University, where we put trades on and we show people how they could make money off one contract. So really you don't have excuse at all in order to trade. A lot of people come to us and say, I don't have the money. Well, this is $50. That means don't go out to dinner one day. Take the dinner money that you have and put it towards the market, and look what can happen. And if you slowly start doing that, you can start building up your cash value and moving forward. Okay, this is exactly how I basically got started, moved from a retail trader to institutional trader, and I'm showing you a perfect example here of how to do that. Okay, if you have any questions, you could email us here or give us a call at any of our office locations here. Have a good day.